Welcome back. This is episode 239. This week I'm joined by Michael Collins. Michael is the CEO of WinCap Financial, an RIA located in Boston, Massachusetts. He's a chartered financial analyst, and he also teaches finance courses at Endicott College and Bunker Hill College. This week we're going to talk investing, talk about some hot topics that are in the news, such as NVIDIA, the Fed, and whether or not large cap growth stocks will continue to do well in 2025. Welcome, Michael.
Hey, Ryan. Thanks for having me on today. I appreciate it.
Yeah, I'm excited. We've known each other for a little while, and from what I've gathered, you're more of a stock picker than I am. I'm more of the boring, index fund. So I think it'll be a good discussion to talk a little bit about some of your, information you have about the markets and such.
Yeah, I mean, it's interesting you bring up the stock picking thing. We certainly do select stocks, but the way we build them is more closer to some of the stuff that you're seeing out of direct indexing. We're probably doing more of an enhanced index, but we're not like shooting for the stars for alpha. It just gives us also an opportunity. Clients who have cash flow needs, in our view, when you have people who need withdrawals and the S&P's down, you're selling the good with the bad.
Sure.
But in years like 2022, we were able to trim from like high flyers, which were like General Mills and Allstate, in an otherwise like terrible year. So we look at it as just more as having more levers to pull when clients need cash flow, as really aside from like a search for alpha.
Yeah, that makes sense. Yeah. About like how many stocks do you have in a typical portfolio?
About 40 to 50 stocks, kind of paired with probably about 10 ETFs and mutual funds for international as well as bonds.
Oh, okay. Okay. Yeah, I was off on that one. I apologize.
No worries at all.
Yeah, but so, as we, we're recording this on January 28th. I think it was yesterday, the news came out that the Chinese company had released, I don't know all the detail, an open source AI, and that was a big hit to NVIDIA.
Yep.
We'll talk a little bit about that.
Yeah, I think this shows that just no one knows anything. When it comes to new technology, you could make some comparisons with crypto and Bitcoin and blockchain with all this as well. Like, no one knows anything, and this, most people are always concerned about like negative surprises and not necessarily positive surprises. And it's hard to tell what this is. At the end of the day, this might disrupt some of the power consumption stories. Or it might be a big nothing, like the Japanese yen thing that we saw, 6 months ago, unrelated to AI, where it was a head fake for the market and a buying opportunity. A lot of investors were like, if NVIDIA comes back down to 120, I'd love to buy it. But, the pain in the news that comes with buying it at that lower price makes people then say, oh, well, now that I know this, I don't know if I want to buy it. I think this is more of an open AI problem, rather than a disruption to the NVIDIA story. But that brings up a separate point just around valuations. I mean, anything that trades above 8 times sales should be viewed as highly skeptical. And NVIDIA was trading at 25 times sales. So it doesn't take much of bad news to kind of get some air out of those tires. Because, throughout history, chips have been cyclical. And, then you ask the most dangerous question in investing, is this time different? So there are some concerns, but it certainly has been priced for perfection. And a lot of people, big companies, I should say, are spending a ton of money on AI to get what is a bit, for many companies, that's like a huge question. Like, Meta's spending a ton on AI. What are we getting, right? And I'm just not sure. Like, rewriting posts with Llama AI is like the end game for this part of the market.
Sure. Yeah. I mean, I'd say that was probably one of the hottest topics of last year, right? AI. Many companies are investing in it. We're using it, right? As individuals and business owners, right? You can type into AI, hey, write an article on this, and it'll spit out an article. The question is, does it really, fundamentally help your company be more profitable and grow? That remains to be seen.
Yeah, and also calls into question like the cost of AI. Can those come down? What does that have to do with the efficiency? There was the big headline was that it was number one in the Apple Store. But it wasn't
the
like
recent,
a million.
the recent, what's it called again?
DeepSeek.
Oh yes, yeah.
And the people downloading that, 99 out of 100 are not like developers working on programs. 99 out of 100 are like people, like college students I teach, who don't want to pay $20 a month for OpenAI, and now there's a Chinese option that's free. So it's not like a million developers poured into this. And again, with AI, it's great that it writes college essays for you, but I don't think that's like the future of a multi-billion-dollar business, right? So a lot of the movement in subscribers or trial users for DeepSeek is just a function of people looking for something at no cost.
Yeah, that's true. I guess one of the big concerns is that I didn't read the user agreement, but I heard that they have access to like all your email or your Gmail. So that might not be great if you do download. I don't know if that's true or not. Did you hear that?
It probably is, but it's not all that different than any other company that we give our data to. Now, I'm not saying it's right or wrong, should it go to China or not, but you could say the same thing about like any other country. There's a world where you're like, do we want this data going to Germany, right? Like that we're not that far off from that environment. And it's how these algorithms are so good. Like how does it know that you were just looking at Nikes, whether it's internet cookies or monitoring your keystrokes, which is a big one. They might not read your text, but they might see the buttons you hit. And at the end of the day, it's 6 of one and half a dozen of the other. It's why some of these algorithms appear so powerful. That being said, I've always been skeptical about directly plugging in AI to client data because of this stuff, right?
Sure.
Like, hey, where does this go, right?
Yeah. It's helpful. Like I was saying, if you want to write something, it'll get you started, but ultimately you're still gotta put your effort into it because it's not there yet. It can't do everything. Maybe it will be someday.
Yeah, maybe it will, right? That's the big question.
Yeah.
Right.
But back to NVIDIA. So I get questions a lot from my clients, and this was prior to a couple of days ago. But hey, we should be buying NVIDIA. Should we be buying NVIDIA? Interesting thing that people might not know, like like we talked about ETFs. One of the largest is the S&P 500. I think NVIDIA is like 7% roughly of that index in itself. So if you're just investing in the S&P 500, you already have a pretty large stake in NVIDIA.
Yep, I would 100% agree with you. That has also become something of an issue if you haven't owned the benchmark, because NVIDIA is such a big part of it. Like not owning NVIDIA might have cost you 5% in performance, right? Just if you owned everything but NVIDIA, you'd still be trailing the benchmark by 5%. So that's another huge issue, and it's also an education issue for clients.
It is, yeah. That's the good thing, the good and bad about a cap-weighted index like the S&P 500. When you get a company that grows as large as NVIDIA has, it just automatically becomes a piece of that index. And so, I think it had overtaken Apple to be the largest holding of the S&P 500. Or was very close. Apple still might be number one, but it was very close.
It's definitely, switched back and forth. I see that. I don't know how persistent that can be. I could be wrong. But again, like, chips tend to be cyclical, and that's just a bigger concern. And maybe what some of the news this week is just showing and shining some of that light at how fast and volatile some of these names, like especially NVIDIA, can be.
Yeah. Normally, you don't see... I think it was an 11, 12% or more sell-off a couple days ago. You don't see that type of volatility with a massive company like that.
Yeah, again, if you compare it to like more of a steadier name like Apple, like usually you don't get like 10% rips in Apple either.
Yeah.
But that being said, sure do wish I owned NVIDIA through the last 2 years.
Well, of course, right? Yeah, it's easy to go back and say, "Oh, I should have bought it at this price." I mean, relative performance the last year, I think it's up over 100%, even despite this recent sell-off in the last couple of days. So it's still doing okay.
100%.
Yeah.
It's a challenge out there.
Yeah. Why don't we switch topics and talk about the Federal Reserve? I think they're meeting. They might be meeting. Was it in a couple days? Let me see here. They're meeting January. Actually, today. January
I thought it was today.
28th. Yeah. So if you're listening to this, it already be out what the Fed does. But let's just talk about maybe the long term. What your thoughts are on their long term, maybe for the year, what they might be thinking.
Yeah. So I think part of the reason both of us weren't immediately aware of when they were speaking is because nothing is supposed to happen today, right?
Yeah.
They're not going to change rates in this meeting, and they're just probably going to talk about the future path of rates, where I'm guessing they're going to say they're data dependent.
Sure.
We've had some good Goldilocks data recently, meaning like, hey, jobs number was good, inflation came in light, the market moved up and down on both of those pieces of news in the last couple of weeks.
Yeah.
And, not uncommon to hear this, but some of this is going to depend on, what Trump does for his policies, whether that's tariffs or deportations. All that stuff is really going to drive some of the inflation. And then you have the core part of it, which is just the strength of the consumer, which, again, still pretty strong. People are still spending money. There's been no, major hiccup in the economy. The other part of the equation is the move towards neutral. Some people will be like, well, why cut rates here? And, we're still, in a constricted state, and you can move those to neutral as inflation normalizes without disrupting too much. There's another thought on inflation and how much of it has been driven by high rates. Now, traditionally, high rates are going to, basically slow down the economy. That hasn't happened as much this time around. And when you look at the stickiest part of the inflation number, that's coming from housing and insurance, but that's a whole separate story. And the housing component, the reason why rents and owner's equivalent rent is up is a function of interest rates, right? They move interest rates to 7%. The landlord knows your next best option has just gotten much more expensive. So they can afford to charge you more, especially, with, moderate housing shortages, depending on where you live. So, I think bringing down the next leg of inflation might actually come from lowering rates. Again, because the stickiest part of inflation is coming from housing, and if they lower mortgage rates or interest rates, that in turn lower mortgage rates, which hasn't really happened yet. That could drive down the cost of housing for buyers, but it could also help renters out too, because that means, for all the reasons I just mentioned.
Yeah, definitely. I think, rents were flat for a long time until a couple years ago, 2-3 years ago, and then they really went crazy. And as a landlord, you're looking to maximize your return, so you're going to keep increasing whatever the market will bear. And at this point, there's a lot more demand because there's a lot of people that can't afford to buy, so they're renting. And I think there's also a housing shortage to begin with, so it's like the ideal time to be a landlord in the sense that you've got really good demand and you can keep prices high. You mentioned earlier about the Fed lowering rates to try to reduce mortgage rates, so that's something at was it last meeting? They cut rates by half a percent. And then the 10-year Treasury, which really dictates lending rates, went the opposite direction. It actually went up. I don't know how much it went up since the Fed meeting, almost probably 0.75%. So it did the opposite, I think, right?
Yeah, the term premium between mortgage rates and the T-bill are at historic highs. So usually the spread between a Treasury and a 30-year fixed is around 1.5%. Today it stands closer to 3%. And I think what that's that's a function of the market, specifically the bond market, pricing in some of the uncertainty that we're talking about today. Is that just it's saying, hey, with all the information we know now, rates shouldn't be coming down. That's what the long-term market is telling us, in contrast to the short-term market. So, we could have a situation where, like, Trump tries to browbeat the Fed in lowering rates, and it doesn't do a whole lot to the mortgage market. The mortgage market almost wants to believe, that rates are heading down and staying down. Now, I can't imagine a world where rates go up here. That would just seem like a pretty disastrous scenario. But, we're waiting for the mortgage market to kind of follow the short-term market of the Fed. And that's definitely been a challenge because they've cut rates enough that you would have thought, all else being equal, mortgages would have come down, but that just so far has not been the case.
Yeah, you would think mortgage rates would be like under 6 or close to 6 on the 30-year,
100% under,
based on where the 10-year was, or the federal funds rate where it is right now.
Yeah, both of those are good proxies. You would think that if we had the average spread, then mortgage rates should be under 6%. They're just not. And figuring out that dissecting, like, why we have that large spread, like, we won't know why that large spread existed for like a year, right?
It takes that long?
Yeah, because, if Trump initiates all his policies and they're inflationary, we're going to look back and be like, oh, that's why the bond market was telling us that 30-year fixed rates are staying high in the face of the Fed cutting rates, because the long-term market read through that news. At least that's how it will be narrated.
Sure.
I don't know if they're just going to compress on their own. There could be other issues too, right? Like, a lot of people left the mortgage market, after, like, the housing, the refi bubble, when low rates ended. So this could also be an issue of, like, less supply of people willing to sell mortgages. I know plenty of people who left that mortgage business over the last 2 years because of all this stuff.
Oh, like got out of selling mortgages, you mean?
Yeah, there could just be less supply, and the existing providers, this is a huge boon to banks, right?
Sure.
Because, like, they're getting lower cost financing and then making, like, a tremendous amount on that spread. I mean, the only thing hurting them is probably volumes, right? Because the volume of loans is lower.
Sure. Yeah, so typical bank, if they're paying you, most banks pay you almost nothing on your money there, but let's say they're paying you 2% and they're lending out at 7%, that's a pretty good deal to sign up for the bank.
And if those spreads stay fat for a long time, again, that's why we've seen banks do so well here, aside from the story we see in chips.
Yeah. So the mortgage market itself is really just a function of supply and demand. It's not like the Fed can decide, okay, we want the 30-year, fixed mortgage to be at 5.5. They have no control over that.
Yeah, they don't. Not in any real sense. I mean, they could always do something to supplement. That wouldn't be the Fed. That'd probably be like Congress or the president. But, even then, that doesn't solve the problem. That's where they might run into issues in terms of, like, how to bring down financing costs, lower housing costs, lower rent, without deflating the economy in a really serious negative way. But, until we get more clarity on, like, what Trump's going to do, then I think some of that premium stays. I mean, it's like, a little bit of the news cycle moves so fast. But I think, like, Trump briefly put, like, 50% tariffs on Colombia because they had a spat about immigration. But, it's stuff like that the market might assign a larger premium under Trump because of the uncertainty he provides in policies related to trade that directly impact inflation.
Sure. Yeah. With mortgages, I mean, 7% is high, in recent view, but not historically. I mean, that unfortunately, that's kind of average for a longer-term trend. It doesn't help people, but I mean, that's the context.
Yeah, for sure. But, it's been like a generation since people have felt a 7% interest rate, I mean, I think we might have briefly hit one, between 2001 and 2008, right? But beyond that, it's like, it's the regular investor in homes is not used to that financing rate, right?
No,
And
definitely not.
and the way some businesses also, like another layer here, talking just about real estate a little bit too, the way some of this commercial real estate is financed a little bit differently. Some of these high rates, along with like low occupancies, have been like really onerous to commercial real estate and stuff as well. So, it's really been, I guess, pun intended, a tale of two cities in real estate. I've even heard from people that some partners at Goldman Sachs were telling me that multifamily housing, effectively apartment buildings, are down like 20% plus in the last year, which again flies into the face of like the single family home market.
Oh,
so
sure.
There's a lot of uncertainty there. I could go down this rabbit hole pretty deep.
Yeah, I didn't realize that. I mean, I was thinking, oh, there's a demand for all residential, apartments, rentals, but maybe not. Or maybe there is, but not if you're trying to sell it per se.
Yeah, and we live in a capitalist economy where, we don't control the housing market, right? And everyone thinks they can make money as a landlord, so then everyone becomes a landlord, and then we have an oversupply of housing. I mean, in the next decade, a good chunk of baby boomers who own a large chunk of the housing stock are going to start to pass away. So, my view is like we're 5 years away, but we could be in a market where we go quickly from undersupplied to oversupplied.
Yeah.
Because the population group of people in their 20s today who are effectively going to be the new buyers from the baby boomers, their population group's like 20 to 30% smaller than the boomers. And with no immigration, who picks up that housing stock? And it's hard to see how in the next 5 years plus, how that plays out.
Sure, especially the second homes, right? Everybody the last 3-4 years wanted in our area to move to Florida, right, the Carolinas,
Yep.
and prices are sky high, but eventually the demand will lessen because those people will pass away or less people want to move there, and then who's going to want to take on those second homes,
Yeah, or maybe you get people like moving from more expensive states, right?
Sure.
That could be another one too.
Yeah.
But it'll be interesting to see how that plays out. I still think 30-year fixed rate comes down this year, but it's going to be the pace at which comes down. I don't think I'm going to point to the stands again this year. Last year I was like mortgage rates are going to end the year at like 5.9, and based on the movement of like where the Treasury was, it should have, right?
Yeah.
But I think the uncertainty in the atmosphere is kind of causing those spreads to widen.
Sure. Well, I hope you're right. Hope it goes down for people. Yeah. So let's just switch to our final topic. Let's talk a little bit about large cap growth stocks. So large cap growth, large cap in general has been in a tear, for the last roughly 10 years. I mean, if we look at like small cap versus large cap, just at the index, I think it's almost about a 90% return for small cap over 10 years, but it's like 170%. Or it's even more, I think. It's over 100% difference, I think, between the two over the last 10 years. So do you think, is that kind of coming to the end? Are we going to see small cap come back into play here, or is large cap still the place to be?
When I went to school, they always talked about like Fama French, which is like, this old study they did on like what factors cause stocks to outperform. And, that analysis always leads towards small value outperforms over time. But for the last decade plus, that has not been the case. And, trees don't grow to the moon. So I think at some point, in a perfect world, these large caps and mega caps like flatline for a bit while the rest of the market catches up. And that's what we believe will happen. Some of this stuff, especially in the mega cap space, appears to be priced for perfection, including valuations. So, for example, I think the S&P, depending on which data you're looking at, has a PE of about, 27. And I'm just looking at some data here, while
Sure.
small caps have a PE closer to like 18. And there's some like different variables in there, like the composition of the index and this and that. But, small looks cheap compared to large. If you want to be a little bit more prudent, I think mid cap is probably the sweet spot because in the small cap space, some of those PE ratios for the index are a bit distorted because of they exclude the unprofitable companies, and there's less of those in the mid cap space. We also think we're going to see a pivot from within technology from semis to software this year. And I think the last few days, the NVIDIA fallout was the other day, was really a broadening out of the bull market. Now, you might say, well, Mike, for a bloodbath of a day, how is that a broadening out of the bull market? Well, if you look at what crushed it the last 2 days, AT&T's up, over 8%. Anything Yelp is up 7%. Salesforce is up close to 10. Palo Alto up close to 5. So you're seeing a lot of money move into software, and I think that falls into the mid cap space a bit more. And additionally, investors who have floated on pretty hard, being in the AI semi space, might have gotten a little bit more cautious and are looking for the next leg of growth. And then just from a narratives perspective, if you mirror this with the internet, Cisco wasn't the winner of the .com bubble, post .com bubble. It was the software companies, not the commodity piping, which NVIDIA could end up being the commodity piping of AI and not the long-term moneymaker. So, we're still waiting on killer apps and not nuanced improvements from
Sure.
AI.
Yeah.
But, we think software valuations within tech, probably can outperform this year compared to hardware and chips.
Yeah. Interesting. Yeah, definitely large cap is priced high, and like we talked about, it's concentrated in a few names just based on how the indexes work, You don't really get that with small cap. It's a lot broader. And, whether you're looking at the Russell 2000 or the small cap, the S&P 600, which some people like better because you're saying there's more profitable names in that versus the Russell 2000.
You think that too, but if there's, I always debate whether I use the Russell 2 or the S&P 6, mostly because, if we're in an environment where small cap is growing, it's probably a junk rally in some ways too, right? It's
Sure.
not high quality small cap. It's usually the lower quality stuff that rallies. So when we've done IWM, the Russell 2, for small cap exposure compared to the S&P 600, again, mostly because I'm all right, if I'm going to lean into small caps, I feel that's a harder way to lean into it in a good way, using the Russell 2.
Interesting, yeah. Yeah, I've used both. I definitely do favor the S&P 600, but there's many ways you can play it.
Oh, of course, there's no right or wrong answer there.
Yeah. Well, awesome. Anything else you want to mention before we wrap up today?
Oh, geez. Nothing on the front of my mind. I think we covered a lot of bases today in terms of topics. I think some of the themes like small and mid cap over large cap, being mindful of where you're going to get interest rate exposure. That was the other thing that happened in the last few days. You saw names that were highly rate sensitive kind of pop as well because, turbulent markets increase the likelihood of rate cuts.
Sure.
But we haven't had any really scary numbers out of inflation. So I think the path is still downward for rates. And the other good news is if there's ever a real disaster, the Fed has a ton of dry powder to make rapid cuts. Where post GFC, that was always the big question for the decade after was where's the dry powder if something bad happens? How do we cut, right? And here we are.
Yeah, that's good.
I will say I'm a final thought. I am against the Bitcoin reserve, by the federal government that's been floated out there.
Yeah, it seems pretty sketchy. I hope that it's not actually going to happen because it does seem not a great idea. Bitcoin's so volatile, right? I mean, not a great idea for government to put their money in Bitcoin and see a 20% loss. We have enough of a deficit as it is. It seemed like it only could worsen it.
Yeah, and it's a slippery slope. If the Fed buys Bitcoin, why not buy Apple? Why not buy NVIDIA?
Sure.
Why not buy Fartcoin?
Yeah.
You know, like all these things. Like, you know, like where does it end? I'd rather the government stay out of stuff like that. You know, not buy speculative assets.
Yeah, I agree. The Bitcoiners will love it, right? It'll be another pop, but probably not great for the regular folks.
The irony with that, though, is that, you know, the Bitcoin people will usually tell you this is like independent of banking, and they want banking independence.
Sure.
At the same time, they want the banks to buy in to give them credibility.
Yeah.
So it's kind of like quite the catch-22.
Yeah. Do you think Bitcoin's going to $1 million ever?
It's hard to say.
Yeah.
I mean, I think a lot of this, the bigger concern I have right now is like all the underlying stuff. People, you know, when you hear about all these like meme coins, a lot of people are buying these like meme coins with levered Bitcoin. So if these meme coins unwind, which I imagine they have to, then that will cause like a lot of selling in crypto because of the levered nature that's applied to Bitcoin to buy all these meme stocks or meme coins.
Sure.
So, you know, that's a concern. I mean, at the end of the day, you know, one of my biggest concerns with Bitcoin is like you're buying something that almost has a messiah complex where like we don't know who invented it, why, don't know anything about it. Would you buy into any other business that had such a mysterious foundation?
Yeah.
You know?
Probably not. I mean, I've stayed out of it. I mean, we couldn't invest in it for a long time anyway for our clients, but we can buy the ETFs obviously. But I just think for the folks that I deal with, and probably you too, close to retiring and retirement, probably too volatile to put a large percentage.
Buy it on your own if you really want it.
That's right.
You know?
Yeah. Yeah, definitely. All right. Well, thanks a lot, Mike. I appreciate you coming on. And
thanks, Ryan. Appreciate
hope you have a great 2025 and have you back on here again in the future.
Thank you.
Okay. All right. Take care.
Bye.
And for everybody, just a reminder that if you have a listener question you want to have considered for a future episode, you can always head over to retirewithryan.com to leave your listener question. And I hope you have a great week. Take care.